Let's take a look at our next example. So the company receives $500 in dividend income from an investment. Okay, maybe we skipped a transaction where the company would have invested in another company as their investment. But let's say the company had invested in another company and now they have received dividend on that investment. What are the accounts that will be impacted? One, again, we know is cash because the company has received $500. What is the other one? Well, in this case, this is the opposite of the expense because the company has received money, which is actually increasing in asset. So we know that definition of income is an increase in asset and also an increase in profit because now the company has $500 more for the owners of the company. So one account is cash, the other one is dividend income. What's happening to cash? Is it increasing or decreasing? Of course, it's increasing. Dividend income is also increasing. So we know when asset increases, there is a debit, and when income increases, there is a credit. So the accounting entry would be debit cash 500, credit dividend income $500. Let's go to the next example. The company buys 10 bicycles for resale at the cost of $5,000 in cash. So what are the two accounts that will be impacted? Again, one is easy, where the company has paid cash. And the other one, bicycles. These bicycles will be kept by the company as long as they are sold, right? So the bicycles are an asset to the company because they are expected to provide economic benefit or money in future, right? So one of the account is inventory. Now, any assets that the company buys for resale and as long as they are with the company and not sold yet are considered stock or inventory in accounting language. And the other side of the entry would of course be cash. So what's happening to inventory? Of course, it's increasing. The company has, let's say, zero inventory of bicycles. Now they have 10 bicycles. So there is an increase in this asset. And on the other side, there is a decrease in the asset, which is cash. So increase in asset is debit, decrease in asset is cash. So accounting entry would be debit inventory, $5,000, credit cash, $5,000. So note that we discussed this in the accounting principles as well, the matching principle. Although the company has purchased these bicycles for sales, but they are not recorded as an expense yet. And the reason is because they have not been sold yet. The amount will be recorded as expense depending on when and how many bicycles are sold. So we are waiting now. We are keeping the bicycles in the inventory as assets until sale is made, and that is the time when we receive the revenue or income from the bicycles. And according to the matching concept, that is when we will record the cost of sales. And now we get to that. So the company now sells 5. Remember, they originally purchased 10 bicycles, but they sell 5 of them for $4,000 in cash. Okay. So there will be two entries at this point. One will be to record the sale and the other one to record the cost of sale. Matching principle. Now, what is the cost per bicycle? We know the company purchased bicycles for $5,000 and there were 10 bicycles. So that means the cost of each bicycle is $500. And the selling price is $4,000 divided by 5 because the company sold 5 bicycles for $4,000. So the selling price is $800. But you can already see on each bicycle, they are making a profit of $300, which is 800 minus 500. Okay. So the company sells 5 bicycles for 4,000. The first entry this will be the sales side of the entry. So the accounts that will be impacted are, one is cash, of course, because the company has received 4,000. The second will be sales or income. So cash is increasing. We are receiving cash, or the company is receiving cash, and sales are also increasing because the company had no sales up until now. But with the sale of these 5 bicycles, the company now has sales of $4,000. So cash is an asset and sales is income. The accounting entry for this one will be debit cash $4,000, credit sales $4,000. Remember again the rules of debit and credit. When liability, equity, and income increase, there is a credit. When liability, equity, and income decrease, there is a debit. On the other hand, when asset and expense increase, there is a debit. And when asset and expense decrease, there is a credit. The rules of debit and credit always apply. the second entry for the same transaction which is sales of 5 bicycles, now we apply the matching principle and record the cost. So originally those 10 bicycles were recorded as inventory. Now 5 of those need to be recorded as cost of sales. So one of the account that will be impacted is the cost of sales. What is the other account? That will be the inventory account, because the inventory was an asset with expected future benefits. Now those future benefits are actually being realized. The asset now converts into expense as cost of sale, and we will record cost of sale of 5 bicycles and a decrease in assets of 5 bicycles. Okay, so cost of sale, inventory, cost of sale is an expense, and this is now being increased. So really this is because of matching principle, because truly the expense is not happening at the time of sale. We had already purchased it, but because we are matching costs and revenue, the expense is being recorded now. The other impact is inventory will decrease. So we had inventory of 10 bicycles, now it has decreased by 5, so there is a decrease in inventory. Cost of sale is an expense, inventory is an asset. So the accounting entry would be debit cost of sales 5 times 500. We know the cost per single bicycle is 500, so the cost of 5 bicycles would be 2500, and credit the same amount, which is inventory, by 2500. Now what happens to the remaining 5 bicycles? They are still part of the remaining inventory balance. So original $5,000, that was the original cost of inventory of 10 bicycles. We sold 2500. Remaining $2,500 will still be in inventory account, the books of the company. When the company sells more bicycles, the inventory balance will be reduced further with the cost of sale entry, the entry number 2 that we just looked at. Note that both sale and cost of sale entries impact the company's profit and ultimately equity. You saw that we noted that the company is making about $300 per bicycle, but the way it's recorded in accounting is through 2 entries. One is the sale entry, where we record the income, and the other entry is the cost of sale entry, where we record the expense. And both these entries have an impact on the profits or equity of the company. Next up, we will learn about the flow of accounting entries.